Let's go ahead and go through the solution to the second of the Module 6 practice problems, the one involving a mid-year acquisition. So again, we have our information that on October 1st, 2021, Big acquired 80% of Little Company for $320,000. The fair value of the non-controlling interest was proportionate at $80,000, and Little Company had the following trial balance as of that date. So again, because it's mid-year, they have some open temporary accounts. They have revenues, expenses, and dividends declared. By the time they get to the end of the year, Little reports total earnings of $140,000 with total annual dividends of $30,000. Our job, of course, is to record the purchase of the investment and all appropriate equity and elimination entries for 2021. Now, before we go any further, let's go ahead and see what they've got to date as far as earnings. They've got $400,000 in sales, they have $300,000 of expenses, so they have income to date of $100,000, and they have dividends declared to date of $20,000. So our first order of business is to determine the book value at the date of acquisition. Now we can do one of two things. We can either simply add the net assets and liabilities at book value, or we can go through sort of a quasi-closing process to determine what the equity accounts would have been had we gone through an actual closing. The simplest thing, of course, is just to add up the assets and subtract the liabilities at book value. So looking at the book values, they've got $380,000 in assets, they've got $50,000 in liabilities, for a book value of $330,000. If you prefer, you can, or just to confirm this, we can go ahead and go through this sort of quasi-closing where income to date is $100,000, dividends to date are $20,000. So if these were closed to retained earnings, then retained earnings would have a balance of $240,000. Again, the current balance is $160,000, add 80, you get to $240,000. That added to the common stock of $90,000 gives us that same book value of $330,000. Okay, so let's go ahead and go through our differential analysis. So again, the fair value, our share cost $320,000, the total is $400,000. The book value that we determined to be $330,000, our share is $264,000, giving us a differential $70,000 total, our share $56,000. So first we subtract out the undervalued property, plant, and equipment. We subtract out the undervalued land. And then finally, recall that the goodwill on Little's balance sheet does not survive the acquisition. Again, think back to what we talked about in the case of a merger. If you acquire another company, the goodwill is not a separately identifiable, the goodwill that they had, the acquired company had, is not a separately identifiable asset. It doesn't meet any of the criteria for recognition as an intangible asset in an acquisition. So essentially the goodwill that existed from an accounting perspective is gone. So this goodwill from an accounting perspective is overvalued. Its value we assume to be 0. So we're going to go ahead and add that back in as an overvalued asset. The remainder, $80,000, is the goodwill we're going to report. Now this may seem sort of silly or odd that we're going to go ahead and take away the $40,000 of goodwill that Little is reporting only to replace it with $80,000 of new goodwill. You could very well ask yourself, why not simply leave Little's $40,000 of goodwill in place and add $40,000 more on top of that? Doesn't that essentially amount to the same thing? And the answer is no. We want to be we should be sure to be careful with this and to always treat this as eliminating the subsidiary's reported goodwill and finding a new total value to replace it. We could run into a problem where if we continued to report goodwill on the subsidiary or the acquired company's books, when that goodwill actually didn't exist any longer, we might find ourselves carrying forward the goodwill on Little's books, but at the same time recording a bargain purchase on our books, when in fact what we should have done is simply negated or gotten rid of the acquired company's goodwill and perhaps recorded a little goodwill of our own. We'll go through another example of this a little bit later. Okay, so the new correct goodwill we're going to report is $80,000. Post-acquisition earnings, $40,000. Again, total annual earnings, $140,000. Earnings as of the date of acquisition, $100,000. Post-acquisition dividends, 10,000. Yearly total of 30, less dividends as of acquisition of 20. Again, our equity method entries. We record the acquisition. We record our share of the post-acquisition earnings. We record our share of the post-acquisition dividends. And we record our share of the post-acquisition amortization. Again, the undervalued equipment is going to be amortized at the rate of $2,000 per year, assuming we're going to round this off to the date of acquisition month. We're going to take 3 months of amortization, October, November, December. So 3/12 of 2,000 is 500. Our share of that is 80%, or $400. Next, for our elimination entries, same drill. Again, as always, we're going to eliminate the date of acquisition or beginning of year owner's equity accounts. We're going to eliminate all of the date of acquisition revenue, expense, and dividend accounts. And now we're going to go ahead and record the differential assets. We go ahead and increase the value of the equipment. We go ahead and increase the value of the land. We remove Little's overvalued goodwill, and we're going to go ahead and replace it with the goodwill that we computed as part of this transaction. That total of $400,000, we split 80-20 between the investment and the non-controlling interest. Continuing, we have our A for amortization, again $2,000 per year for 3 months. I for investment income, again we can simply add up our equity method entries. And then D for dividends declared, again there's $30,000 of total dividends declared on Little's trial balance. We eliminated $20,000 of that in that initial S entry, so now we're only faced with eliminating the remaining post-acquisition dividends of $10,000. We'll go ahead and split that $10,000 in the usual fashion, 80-20 between the parent's investment and the non-controlling interest. And then finally we do the income of the non-controlling interest in the usual fashion. They're going to get their share, 20%, the post-acquisition earnings of $40,000 minus that additional, or minus the additional depreciation expense of $500.